Then US stocks fell out of bed a little bit yesterday. Nvidia was at the vanguard of that move, but nevertheless, the bond market story is front and centre. Is this sell-off just getting going if yields continue to rise?
Well, I think that, there's the well-known January effect, Guy, when investors are supposed to be in favor of buying stocks at the start of the new year. This time around, I fear that the Ides of January have come to roost the markets. And the market is beginning to demonstrate that good news for the economy is bad news for stocks. Then there is the question of overzealous valuations, with the S&P offering an earnings yield of just about 4%. If you look at the Nasdaq 100, the basket offers just about 3%. So if you calculate the fair value on the S&P 500, it works out to around 4,800 on my model. So the market is basically trading 25% above where it ought to be trading. So it's almost as if you could park a jumbo jet between where it is indicated and where it actually is. So the risk reward at these levels seems skewed, is distinctly in favor of a correction. And of course, you've got the Trump inauguration coming up as well. And that is also, investors are likely to be jittery ahead of that inauguration, because who knows what announcement is going to come from White House on tariffs.
Who knows indeed. But just to bring it back to the bond story, I mean, you reckon that 5% yields on the 10-year are possible. Why not 6% then? I
think that 6% may be over-egging it, Lizzie. I think that having said that, I think that the bear case for duration is well-founded. The MOVE index, which gives a robust indication of what traders are thinking, reckons that 10-year rates will settle somewhere between 360 and 555 in a year's time, and that is with a 1 standard deviation certainty. Treasury 10-year rates have already shot up some 80 basis points since the market started factoring in the Trump trade. So the markets are kind of almost well prepared that Trump might slap some tariffs and stoke inflation. They've partially priced in what he may announce. They front-run it. So it all depends on what he announces and whether he announces anything on January 20. So the pricing means that there's further sell-off in Treasuries likely, and that will be to the tune of 20 to 30 basis points on the 10-year from here. So I think that we are going to tread water around the current levels until Trump takes office, and depending on, they will bifurcate from there depending on what he's going to announce on tariffs.